Have you ever watched a market trend suddenly collapse and wondered how the professionals seem to know exactly when to get out while everyone else just rode it straight down?
It is the most frustrating feeling in the world for a retail investor.
Oh, completely. Picture this. It's a random Tuesday morning. You wake up, you grab your coffee, you pull up your portfolio on your phone, and it is just a sea of red
A
candles.
total bloodbath.
Exactly. The bottom has completely fallen out of a market that, just 24 hours ago, it looked like it was going to go forever.
Right.
So you pull up the news and everyone is panicking, but then you look at the filing data or you hear the whispers from the institutional desks and you realize the heavyweights of the financial world headed for the exits weeks ago.
They walked out the door right before the floor fell through.
Yes. And it's a maddening experience for anyone participating in financial markets. You stare at your screen and ask yourself, what are they seeing that I am not? We are looking at the exact same charts,
Right.
right? The same price action, the same data.
But you're interpreting it through a completely different lens.
Which brings us to our mission today. Welcome to this deep dive. Today, our goal is to completely unpack the hidden machinery of financial markets. We're going way beyond the surface level noise to explore a massive, often completely misunderstood difference in how markets actually operate.
And this is a big one.
It really is.
Yeah.
Specifically, we are exploring the critical distinction between a market trend and a market campaign.
That distinction completely changes how you view every single blip of price action on your screen. And honestly, the terminology gets thrown around so casually in the financial media that the true meaning gets completely lost in translation.
I used to be guilty of this myself, I have to admit. If you spend any time in trading discussions or, listening to financial commentary, you hear people use these terms interchangeably.
Oh, what the heck?
They talk as if a trend and a campaign are the exact same thing. A pundit will confidently talk about trading the trend and then in the very next breath talk about running a campaign in the same direction.
Yeah, and at first glance, it really does just feel like semantics.
Right, just two different words for buying an asset that is going up or shorting one that is going down.
But that casual overlap in vocabulary is exactly where the trap is set for the average market participant.
Mm.
Because the difference between a trend and a campaign isn't minor at all.
It's not just semantics.
Not even close.
Yeah.
It is fundamentally structural. It is a deeply meaningful difference in the actual mechanics of how capital moves around the globe. Understanding this distinction is the literal difference between just passively watching what a market is doing on a screen versus knowing when your participation actually carries a massive structural advantage.
Okay, let's unpack this. We need to start with the baseline, the thing everyone thinks they understand inside and out. Let's talk about the illusion of the chart and define what a market trend actually is.
Sure. In the simplest, most fundamental terms, a trend is the observable reality.
The thing everyone can see?
Exactly. It's the sustained directional movement of price across time. You pull up a chart on your trading terminal, and it's staring right back at you. If the price is making higher highs and higher lows, it's an uptrend. If it's making lower highs and lower lows, it's a downtrend. It's universally recognizable.
It's basically empiric proof of what happened.
It's entirely empirical.
Ah,
And because it's so visible, the financial industry has developed an incredible, almost dizzying array of tools to observe and measure it. You have moving averages, which just take the closing prices over a certain number of days and smooth out the daily volatility to show you the broader trajectory.
right, so instead of seeing the chaotic day-to-day jumps, you just see a smooth line pointing up or down.
Spot on. And then you have momentum indicators.
Yeah.
Things like the RSI, the Relative Strength Index.
Which is everywhere.
It is. Think of the RSI like a thermometer for the market. It tries to tell you if a trend is running too hot or too cold by measuring the speed and change of price movements.
Yeah.
Or you have the MAD, which is basically a speedometer, trying to measure the velocity of that trend.
And beyond those basic retail tools, there's a whole other level, right?
Oh, absolutely. You have incredibly complex statistical trend models run by supercomputers. Entire massive industries have been built purely around identifying and exploiting these observable trends. Think about the entire field of technical analysis.
Multi-billion-dollar systematic trend-following funds.
Yes, and the legions of discretionary day traders.
Hmm.
All of their methodologies are predicated on the idea that once a trend is in motion, it is statistically likely to stay in motion.
Okay, but wait. If these multi-billion-dollar trend-following funds are built entirely on these charts, isn't there an argument that the chart is the only truth that matters? I mean, why do we even need to know the why if the moving average crossover is making us money? Does a chart actually tell you why something is happening?
That is the ultimate question. And the answer is a hard no. A chart tells you absolutely nothing about the why.
Nothing at all.
Nothing. You can have the most beautifully configured chart on your screen. The moving averages are fanned out perfectly. The RSI is sitting in the exact sweet spot. The price is writing a perfect geometric channel. But that geometric pattern doesn't explain the fundamental driver of the price action.
It's just geometry.
Right. That is the crucial limitation of trend analysis. A trend is simply the observable result of collective positioning. That's all it is. It's an artifact of human and algorithmic behavior.
So it's just the footprint left in the snow.
That's a great way to look at it. When you see a trend, what you are actually seeing is a massive imbalance in the market. You are looking at a moment in time where institutions, global macro funds, corporate hedgers, and individual retail participants all happen to align their exposure in the exact same direction.
And when everyone is on the same side of the boat,
The price moves. When the buying pressure vastly outweighs the selling pressure, the price has no choice but to gradually adjust upward to reflect that massive imbalance. The trend is just the footprint left behind by that capital flow.
so the chart is basically the rearview mirror of the financial markets.
You hit the nail on the head. The trend describes the outcome, not the cause.
Mhm.
It shows you what has happened up to this very millisecond, and it shows you the current trajectory based on historical momentum. But it is completely blind to why it's happening.
Which means it can't tell you when it's going to stop.
Exactly. It tells you nothing about the underlying macroeconomic forces that initiated the move. And more importantly, and this is where people lose their shirts, it tells you nothing about whether those underlying forces are still valid today.
But the real story is what happens beneath that surface. This brings us to the hidden engine of market movement. If the trend is just the visible outcome, what is a market campaign? Because from what we're discussing, a campaign doesn't describe the direction of the price at all.
No, it doesn't. A campaign is a fundamentally different concept. A campaign refers to strategic engagement with a market move, specifically when structural conditions create highly favorable incentives.
Okay, break that down for me. Favorable incentives.
Let me simplify it. A campaign is all about asymmetry. It's about identifying a very specific moment in time where the underlying macroeconomic reality of the world is completely disconnected from the current market pricing.
So the market has it wrong.
The market is lagging behind reality. And that disconnection creates an environment where a massive repricing isn't just possible, it's virtually inevitable.
So a campaign needs fuel. It needs a massive catalyst that forces all of that institutional capital to move in the first place. You mentioned structural conditions creating favorable incentives. Let's really dig into this. What are the specific forces, the ingredients that must align to create this campaign environment? Because we aren't just talking about a tech company having a good quarterly earnings report here, are we?
Not at all. We are talking about macro-level forces that dictate the flow of hundreds of billions, sometimes trillions of dollars across borders. The first, and often most powerful ingredient, is diverging monetary policy between major economies.
Okay, let's play this out. I want to make sure I'm following the mechanics here. So if I'm a massive fund manager sitting in London, and I see the U.S. Federal Reserve aggressively raising interest rates to combat inflation, but the Bank of England is cutting rates because the UK economy is struggling, how does that dictate my next move?
It dictates your move because it creates a massive gravitational pull on your capital. Let's use the analogy of a global seesaw of capital. Capital is incredibly rational at the highest levels. It always flows where it is treated best and compensated the highest for the risk taken.
So it chases the yield.
Exactly. If the U.S. is offering a 5% risk-free return on their government bonds because they are raising rates, and the U.K. is only offering a 1% return because they are cutting rates, the decision is made for you.
You dump the pounds.
You sell your British pounds, you buy U.S. dollars, and you park that money in U.S. treasuries. When thousands of institutions do this simultaneously, it creates a massive structural trend in the currency markets.
That makes perfect sense. And that flows right into the second ingredient you often hear about, yield differentials.
They are intimately connected. Yield differentials are the physical manifestation of that diverging policy. When the bond yields in one country spike relative to another, institutional investors, sovereign wealth funds, and massive pension funds actually have a fiduciary duty to reallocate their capital to capture that higher yield.
Wait, a fiduciary duty, so they don't even have a choice?
In many cases, no. Think about a giant pension fund that has to pay out millions to retirees every single month. They need a specific annualized return to stay solvent. If they can get a guaranteed higher yield by moving money across the ocean, They are legally obligated to do so.
Wow.
And that reallocation requires buying one currency and selling another, creating massive, undeniable structural positioning shifts.
So it isn't even about speculation at that level. It's about fundamental financial survival and obligation. What about global liquidity conditions? We hear the word liquidity thrown around constantly. What does that actually mean in the context of a campaign?
Global liquidity is the lifeblood of risk assets. Think of liquidity as the total amount of cash and credit sloshing around the global financial system. When central banks are expanding their balance sheets, meaning they're basically printing money and using it to buy bonds from banks, they are injecting liquidity into the system.
Quantitative easing.
Right. And when they do this, money becomes incredibly cheap and abundant.
So when the system is flooded with cheap money, what does that capital do? It can't just sit in a bank account earning zero.
That's the key. It forces capital out further on the risk curve. Investors can't get returns in safe bonds anymore, so they are forced to buy equities, emerging market stocks, high-yield corporate debt, or commodities. It creates a structural campaign to buy risk assets across the board.
And the reverse is also true, I imagine.
Absolutely. When central banks reverse course and start draining liquidity from the system, quantitative tightening money becomes scarce and expensive. That initiates a structural campaign to sell risk assets and move capital back into safe havens like the US dollar or short-term government bills.
Okay, so we have diverging monetary policy, yield differentials, global liquidity conditions. What about the actual physical economies? Does macroeconomic divergence play a role?
It is massive. Macroeconomic divergence is when the physical economies of different regions are on completely different trajectories. It's the real world versus the paper world.
Give me an example of that.
Imagine one region experiencing a massive boom in industrial production, driven by a young, growing demographic and technological innovation. Now contrast that with another region that is slipping into a demographic winter, where the population is aging, manufacturing is shrinking, and energy costs are skyrocketing.
The real-world economic reality eventually has to be reflected in the stock markets and currencies of those regions.
It's unavoidable. You can't have a permanently booming stock market in a country where the underlying industrial base is collapsing. The financial assets tied to those regions eventually face a violent repricing to match reality.
Okay, that makes sense.
And finally, the last major ingredient for a campaign is positioning imbalances across different markets.
Explain positioning imbalances to me. How does knowing what everyone else is doing create an opportunity?
Well, sometimes a market becomes so universally despised or so universally loved that everyone who could possibly buy or sell has already done so. Let's say there's a particular commodity, maybe copper or crude oil, and the narrative is so terrible that every single hedge fund on Wall Street is aggressively shorting it. They're all betting the price will go down.
If everyone has already placed their bet that it's going down, who is left to actually sell and push the price lower?
Nobody. That's the point of maximum vulnerability. The positioning is stretched to its absolute physical limit. When you have an extreme imbalance like that, all it takes is a tiny, unexpected shift in the structural narrative.
Like a supply shock.
Exactly. A mine shuts down unexpectedly, or a central bank hints at a stimulus package. Suddenly, all those hedge funds realize they're trapped on the wrong side of the boat. They all have to buy the commodity back simultaneously to cover their short positions. You get a massive, violent unwinding.
So recognizing that extreme imbalance and waiting for the catalyst is a key component of identifying a campaign opportunity.
Precisely.
Okay, let's pause there for a second because I want to make sure the framework is crystal clear for everyone listening. When you hear the word trade, you generally think of a singular action. I opened my app, I bought a stock, I called my broker, I sold a futures contract. But a campaign is clearly not a trade. A trade is just an execution. A campaign sounds like an entire philosophical framework.
It is. It is a framework for managing multiple executions within a much broader structural opportunity as it unfolds over a long period of time. A campaign might last 6 months, a year, or even 3 years. During the lifespan of that campaign, a professional participant might execute hundreds of individual trades.
So they aren't just buying once and walking away.
Far from it. They might buy the initial breakout when the structural shift first happens. Then when the market gets a little overheated and consolidates, they might take some profits.
Trim the position a bit.
Exactly. And then if there's a sudden pullback because of a scary news headline, they might use that fear to add back to their position at a better price. They might hedge their exposure using options right before a major inflation report is released.
But all of those moves.
All of those individual tactical executions are governed by the overarching campaign thesis. They are not trading the random wiggles on the chart. They're meticulously managing their exposure to a massive structural shift in the world.
That highlights a massive philosophical difference. Trends are observable. As long as you have a live data feed and a working set of eyes, you can see a trend. You don't need a PhD in economics to see that a line is moving from the bottom left of your screen to the top right. But campaigns are entirely interpretive.
That's the reality of it. And this is why campaign thinking is generally the domain of macro traders and large institutional heavyweights. To identify a campaign, you have to perform deep structural analysis on factors that exist entirely outside the price chart.
You have to do the homework.
You really do. You have to read the boring 100-page central bank minutes. You have to build complex models mapping out forward inflation expectations. You have to analyze geopolitical shifts, supply chain bottlenecks, and demographic data.
None of that information is printed on a candlestick chart.
0% of it is on the chart. You have to synthesize a mountain of external data and interpret what it means for the future flow of capital. You have to figure out where the money has to go before it actually gets there.
Now here's where it gets interesting, the timeline. Because these two things, the campaign and the trend, do not start at the same time. There is a massive timeline disconnect, and when it comes to markets, timing is literally everything. Let's talk about the birth of a campaign, because it sounds like the campaign starts breathing long before the trend ever shows its face to the public.
Oh, absolutely. The origin point of a campaign is almost always invisible to the purely technical trader. When those structural incentives we just discussed first begin to shift, when a central bank subtly changes its forward guidance in a press conference, or when a quiet change in global banking liquidity begins to take hold, the early participants, the smart money, recognize the asymmetry immediately.
They see the gap between the price and reality.
They see that the current price of an asset is completely misaligned with the new structural reality that is forming, so they quietly begin building their exposure.
And what does the market look like at this exact moment? If I pull up my chart while they're doing this, what am I seeing?
You are likely seeing total noise. The price movement might look completely erratic. It might be chopping around in a frustrating range-bound mess, stopping out day traders left and right. It might even be trending slightly in the opposite direction of the new structural reality.
Wait, why does it look so chaotic? If the smart money is buying, shouldn't the price be going up?
You have to understand the mechanics of large institutional orders. A massive macro fund can't just press a button and buy $1 billion worth of an asset. If they did that, they would spike the price and ruin their own entry point.
Right, they bid it up against themselves.
Exactly. So they have to disguise their buying. They use algorithmic execution to slice their massive order into thousands of tiny pieces over weeks or months. Furthermore, the broader market simply hasn't realized the underlying divergence yet.
So everyone else is just trading the old news.
The retail participants and the momentum algorithms are still reacting to yesterday's narrative. So the early campaign participants are using that confusion, that erratic price action, to absorb liquidity. They are buying quietly from all the people who are panic selling or trading the old story. They are building a massive foundation without moving the market prematurely.
So they're basically accumulating their position in the shadows, but eventually the dam has to break.
It always does. Eventually, the structural reality becomes undeniable. The hard economic data finally confirms the shift, or the central bank takes explicit action by officially cutting or raising rates. Suddenly, the broader institutional world realizes they are behind the curve, and billions of dollars come rushing in to catch up.
The secret is out.
The broader market wakes up to the new reality. And it is at this exact moment that the trend finally emerges on the chart. The moving averages cross over, the RSI spikes.
And this is the golden period, right? This is when everything is perfectly aligned.
This is the sweet spot. For a beautiful window of time, the campaign and the trend coexist perfectly. The price is moving aggressively in a clear, clean direction, and the underlying structural incentives are still backing it up, pushing it forward with immense fundamental force. The macroeconomic reality and the technical chart are singing in perfect harmony.
That's where the massive returns happen.
Because this is when the early participants are experiencing their maximum structural advantage. They are already fully positioned, and now everyone else is doing the heavy lifting to push the price in their favor.
So what happens when everyone finally catches on? Because nothing stays a secret forever in finance. Eventually, that trend is the #1 story on the financial news networks. It's trending on social media. Every retail trader is posting screenshots of their gains, talking about how incredibly easy it is to make money in this specific market.
When you see that happening, that is the beginning of the end for the campaign. As more and more participants pile into the trade, the conditions naturally evolve. The market is a discounting mechanism. It prices in the structural shift.
So the asymmetry vanishes.
Let's go back to our yield differential example. If the campaign was based on the U.S. offering higher yields than the U.K., eventually the U.S. dollar appreciates so much that the new, higher exchange rate perfectly offsets the difference in interest rates. The gap closes. The asymmetry vanishes.
The juice is squeezed.
That's the reality. The fundamental incentives weaken. Furthermore, positioning becomes dangerously crowded. When everyone in the world is already long an asset, who is left to buy it and push the price higher? Nobody.
You've run out of buyers.
Exactly. And the liquidity conditions can also shift as the macroeconomic cycle progresses into its next phase. When these things happen, the campaign opportunity, the actual structural edge that gave you an unfair advantage, begins to severely deteriorate.
And that brings us to the most dangerous part of this entire dynamic, the ghost in the machine. Because the big reveal here, the trap that catches so many average investors, is that a trend can continue for a long, long time after the original campaign that created it has completely died.
It happens constantly.
The structural engine is dead, there's no gas in the tank, but the car is still rolling down the highway at 80 miles an hour.
And this raises an incredibly important question for anyone managing money. Why does the market keep moving if the fundamental reason for the move is gone?
Yeah, why doesn't it just stop?
It comes down to the mechanics of inertia. Once a trend is firmly established in the global markets, it builds a mindless, self-sustaining momentum that can completely detach from the underlying macroeconomic reality. There are three massive forces that keep what we might call a zombie trend moving forward, tricking people into thinking the opportunity is still alive.
Let's break those down, because this is where the casualties happen. Force number one.
Force number one is the systematic funds. These are massive pools of capital run by supercomputers that employ strict momentum algorithms. I cannot stress this enough. These algorithms do not read the news.
They aren't watching central bank press conferences.
They do not care about central bank policy. They don't care about geopolitical conflicts or inflation data. They are mathematically blind to the structural campaign. All they do is ingest raw price data. And as long as the price continues to trigger positive momentum signals, as long as the short-term moving average stays above the long-term moving average, these algorithms will blindly continue to buy.
So they reinforce the trend with automated volume?
They create a massive feedback loop.
It's a self-fulfilling prophecy at that point. The computers buy because the price is going up, and the price goes up because the computers are buying.
You've got it. And that leads us to force number two, retail traders. Historically, retail participation happens very late in the market cycle. By the time a trend is glaringly obvious on a basic phone app chart, by the time it is generating breathless headlines on cable news, the structural edge is usually long gone.
But they don't know that.
Right. Retail traders, driven by a deep psychological fear of missing out, or FOMO, see the historical performance. They see their neighbors making money. So they throw their capital into the market, providing another massive wave of completely uninformed, emotionally driven flow that pushes the price even higher into the stratosphere.
They are essentially buying the top. And the third force.
The third force is slow-moving institutional portfolios. This is where we need a good analogy. Think of a nimble algorithmic hedge fund, like a speedboat. If the market turns, that speedboat can whip round and change direction in 3 seconds flat.
So you have soulless algos buying blindly, retail traders buying out of pure FOMO, and massive oil tanker institutions buying because they're just too big to turn the ship around quickly.
That is the zombie trend.
And that creates a terrifying trap for the listener, because you pull up your chart on that random Tuesday, and the trend is still beautifully intact. The screen is green. It looks like the easiest, safest trade in the world. But the actual reason for the move, the structural edge, is dead. The asymmetry is completely gone. You are walking into a minefield thinking it's a playground.
You are participating in the ghost of a campaign. And because the structural foundation is gone, the market is incredibly vulnerable. Think of it like a massive skyscraper built on a foundation of sand. Without that fundamental anchor holding it in place, all it takes is a minor shock.
Just a little push.
A tiny shift in sentiment, a slightly bad earnings report, a weird comment from a politician. Because everyone is crowded on one side of the boat, and there is no underlying macro reason for them to be there anymore, that tiny shock causes a panic. When the exit rush starts, and the momentum algos flip from buy to sell, the drop is catastrophic.
Let's zoom out for a second. We have been talking in theoretical terms, but I want to ground this in a real-world example so you can truly see how this plays out on the global stage.
Hmm.
We need to look at a classic case study, the 2014 to 2015 US dollar cycle. Take us back to 2014. Set the stage for us. What was happening in the macroeconomic world?
2014 was a textbook, historically perfect example of a macro campaign environment. We were several years out from the 2008 financial crisis, and we had a massive historic policy divergence happening between the major central banks of the world.
So the US versus everybody else.
Pretty much. In the United States, the Federal Reserve, after years of unprecedented money printing and 0% interest rates, was finally preparing to change course. The U.S. economy was recovering, so they were signaling an aggressive shift to strip away that crisis-era monetary accommodation.
The famous taper.
Yes. They were preparing to taper their bond purchases, meaning they were going to stop injecting liquidity, and eventually they were going to raise interest rates.
So the US was tightening the belt. Money was about to become significantly more expensive and harder to get in the American system.
That was the trajectory.
Mm.
But meanwhile, across the oceans, the situation was completely different. The European Central Bank, led by Mario Draghi, and the Bank of Japan, led by Haruki Kuroda, were dealing with struggling, stagnant economies.
They were still in crisis mode.
They were doing the exact opposite of the U.S. Fed. They were aggressively expanding their stimulus programs. They were firing monetary bazookas. They were printing money and pushing their own interest rates down, in some cases into negative territory, which is wild to even think about.
That is the ultimate divergence right there. The U.S. is pulling the punch bowl away, pulling liquidity out of the system, and Europe and Japan are backing up a dump truck and flooding their systems with cheap cash.
What's fascinating here is how this specific, massive divergence created an undeniable structural incentive. It goes back to our carry trade mechanics. If you are a global capital manager sitting in Frankfurt or Tokyo, your local government bonds are yielding zero or even negative returns. You are actually paying the government to hold your money.
Which is insane.
It is, but the U.S. Federal Reserve is telegraphing that they're about to raise rates, making U.S. Treasury bonds yield 2%, 3%, or 4%. What are you forced to do?
I'm forced to sell my local currency. I buy U.S. dollars, and I park that money in U.S. assets. It's a complete no-brainer. I'm going to pay a premium just for moving my money.
It is a structural mandate. Global capital began to flood into dollar-denominated assets. This was the birth of the campaign. Early participants, the major macro hedge funds, saw this policy divergence forming long before it hit the mainstream headlines. They read the speeches, they modeled the inflation data, they quietly built massive, leveraged, long positions in the U.S. dollar against the euro and the Japanese yen.
And as they built those massive positions and the policy divergence became official, undeniable reality, the trend emerged on the charts.
And what a trend it was. It was a massive, sustained appreciation trend. The U.S. dollar index went completely parabolic. The euro fell from around 1.39 down to nearly 1.05 in a relentless slide.
That is a historic move for a major currency.
It was one of the cleanest, most powerful technical trends of the entire decade. For a long period stretching through 2014, the campaign and the trend were beautifully aligned. The macro funds were making fortunes, and the trend followers were making fortunes alongside them.
But let's fast forward to the later stages of that move, into early to mid-2015.
By 2015, the landscape had changed entirely. The divergence that the early participants had predicted had become a hardened reality. The Fed had made their moves, the ECB had made their moves, and more importantly, the market, being an efficient discounting mechanism, had completely priced in that divergence.
The market caught up.
Exactly. The value of the dollar had risen so much that the new, much higher exchange rate fully accounted for the difference in interest rates.
So the asymmetry, the unfair advantage was gone. The gap was closed.
The trade became incredibly crowded. Every systematic trend-following algorithm in the world was maximally long the dollar. Every retail trader was buying the dollar on every minor dip, convinced it was going to parity with the euro. Financial magazines had bullish illustrations of the U.S. dollar on their front covers.
The classic magazine cover indicator usually assigned the top is in.
Almost always. And because everyone was already in the trade, the risk-reward ratio completely fell apart. Volatility spiked dramatically. The easy, smooth uptrend turned into a violent, choppy roller coaster that started wiping out retail accounts.
I can actually picture this. I remember seeing professionals operating during times like this. The whole trading floor is cheering because their trend algos are printing money on screen. But the senior macro guys, the ones who really understand the underlying plumbing, are quietly packing up their boxes.
Because they know the music is stopping.
Exactly. They are taking their profits, reducing their leverage, and going on vacation. They know the ghost is in the machine. This is the climax of the story, the moment that separates the professionals from the amateurs, the smart exit.
The professional macro traders recognize that the campaign had matured. The structural engine had run completely out of fuel. So what did they do? They didn't wait for the moving averages to cross. They started systematically reducing their exposure. They quietly sold their massive dollar positions to all the late-arriving retail traders and momentum algorithms who were eager to buy at the top. They walked away, locking in their massive gains.
And they did this even while the massive US dollar trend was still clearly visible on every technical chart in the world.
That is the hardest part for people to grasp. If you only looked at the chart in early 2015, the dollar still looked incredibly bullish. It was still making higher highs. The moving averages were still pointing straight up.
But the professionals were already out.
They knew the campaign was over. They exited the campaign long before the trend actually broke. And sure enough, eventually, the sheer weight of that crowded positioning collapsed under its own mass. The dollar entered a brutal, multi-year consolidation and correction phase, violently trapping all the latecomers who were trading the ghost of the trend.
So what does this all mean for you? We have broken down the dense theory, we have looked at the historical plumbing, but how does understanding this fundamental difference actually shift the way you operate in the markets tomorrow morning? We need a trader's playbook based on these strategic implications.
It has to fundamentally rewrite your entire approach to market engagement. The first rule of this new playbook is that campaign thinking forces earlier participation. If you rely solely on lagging technical trends, you are inherently, mathematically, a latecomer.
You are always reacting.
You are waiting for the market to move, for the imbalance to occur before you act. But if you analyze structural campaigns, you are actively looking for the underlying shifts before the trend is obvious to the crowd.
You are looking at central bank minutes instead of moving averages. You are looking at the macro puzzle pieces.
You are building the puzzle before everyone else realizes it's a picture. By identifying policy shifts, yield differentials, or massive liquidity changes early, you can position your capital before the trade gets crowded. You capture the maximum asymmetry when the risk is actually the lowest.
Rule number 2 is perhaps the most vital takeaway of this entire deep dive. And honestly, it is the hardest thing to master psychologically: disciplined exits.
This is where almost everyone fails, even smart people. Human psychology, specifically loss aversion and greed, makes us want to hold on to a winning trade for as long as the price is going up. It feels good to watch the green numbers get bigger.
Nobody wants to sell when it's going up.
But a campaign trader operates with cold discipline. You do not hold a position just because the price on the screen is still moving in your favor. You constantly monitor the underlying structural incentives that put you in the trade in the first place.
You are watching the engine, not the speedometer.
I love that analogy. You monitor the engine. The moment the structural incentives weaken, the moment the central banks converge, or the yield differential closes, or the positioning becomes historically crowded and everyone's on one side of the boat, you reduce your exposure.
You take your chips off the table.
You exit the campaign, even if the technical trend on the chart hasn't shown a single sign of reversing yet. You are not trying to squeeze the last dangerous 5% out of a move if the structural risk-reward has turned against you.
It takes an incredible amount of emotional control to sell an asset that went up 2% today just because your macro model tells you the campaign is over. And that leads perfectly into Rule 3, capital rotation, the ability to move on.
Markets are completely dynamic. They are a living, breathing ecosystem. They are constantly generating fresh divergences and new structural opportunities somewhere in the world. When one campaign matures and becomes a crowded zombie trend, you don't cling to it, hoping for another miracle leg up.
You rotate your capital.
You take the profits from the aging campaign and you deploy them into the next emerging structural shift that no one on financial television is talking about yet.
You are constantly hunting for the new asymmetry rather than babysitting the old one.
You have to keep moving.
Let's bring this all together. Let's synthesize everything we have covered into the core philosophy that people can take away from this deep dive.
It all comes down to this core truth. Trends tell you what the price is doing right now. Campaigns tell you when participating in that movement actually gives you an unfair structural advantage.
It's the difference between trailing the pack and leading it.
Exactly. The goal of a sophisticated market participant is not to ride every single inch of a trend from the absolute bottom to the absolute top. The goal is to be fully engaged with heavy capital, only during that beautiful window of time when the asymmetry is heavily in your favor, when the structural fundamentals are actively pushing the price.
And when that fades,
When that structural edge disappears, you step aside, protect your capital, and let the blind algorithms and the emotional latecomers fight over the dangerous scraps of the trend.
and that brings us to the end of our journey today. But before you go, I want to leave you with a final lingering thought to mull over. Think about the biggest, most obvious market moves happening in the world right now as you listen to this. Think about the charts that are dominating your social media feeds, the parabolic run-ups that everyone in your life, your barber, your neighbors, seems to be talking about. Look at those charts and ask yourself a very hard question. Are you looking at a fresh campaign with a powerful, hidden structural engine driving it forward? Or are you just staring at the ghost of a trend fueled by nothing but blind algorithm momentum and human FOMO, whose actual structural edge died months ago? The answer to that question changes everything. Thanks for diving deep with us.